All right, so after proceeding with this, now let's go to another technique called payback period. So let's proceed with the payback period here. How do we deal with payback period? Here we are at payback period. This is the second method of investment appraisal and the non-discounted cash flow methods. So simply speaking, what is payback period? Payback period, actually, this is the method that emphasizing recovery of the initial investment cost of the project as much as earlier as possible. As early as possible. So that's why we say it is the time taken for initial investment to be recovered in the cash flows from the project, just like this. It is particularly relevant if there are liquidity problems or if forecasts are very, very uncertain. You find that liquidity problems or cash flows are very uncertain. Why? If you have liquidity problem, that means you require cash more quickly. But also, if forecasts are very uncertain, payback period is a method used as a screening test. It is used to screen the investment, to flash the investment, to just get a quick picture on whether the investment could give us something good, could give us better results, good results or not. So that's why most companies using payback period just use it as the initial state, as the initial way of just evaluating projects, not the final one. If the payback period seems good, and then they can proceed with NPV just like that and other methods. So here we are told the payback period is the one which gives a greater weight to cash flows generated in earlier years. Exactly. I think we'll see this when speaking. You can let's say you invested $10 million, but at the end of year one, you have $8 million, end of year two, $4 million, and end of year three, let's say you have much less. But in case you have a project, you can have a project that gives you, let's say it stays for 10 years, but gives you $100 million after 10 years. You can ignore it because you see that to obtain those cash flows, it will be much, much later. But actually, this is the main disadvantage of the payback period, because actually, you can actually lose a lot of money. So here we are told the payback period is calculated by identifying the point at which net cash flows, inflows equal to the cash or to the cost of the initial investment. So the criterion, how do you know that after computing the payback period, how do you know that you can proceed with the investment or you have to discard the investment? Actually, we have the criteria. We say that the investment is financially acceptable if payback period is within the target payback period. Let's say, suppose you say that actually to perform this investment, to undertake this investment, it should not take more than 2 years. Then you have to complete payback period and check whether it has exceeded 2 years or not. If it has exceeded, you actually have to discard it. But also for competing investments, let's say you have two investments using the same resources, using the same labor, maybe money isn't enough, using the same amount of money. Priority is to those with the shortest payback periods. So prioritize those with the shortest payback period, just like this. So let's just take a look at advantages and disadvantages, and then we'll just go one example. I think you can just read the disadvantages directly because payback period just gives you, let's say, 2 years, 2.5 years, 3 years, just like that. So how does that figure benefit you? When performing investment, there is something very, very useful. It's very nice that you perform an investment and you know that you will add this value to the company. And it's only the net present value method that gives you that. So among the disadvantages of all methods, you could say under disadvantages here, it does not give results in absolute monetary terms. So advantages of payback period. Here we are told it is simple to understand and easy to calculate. Of course, this is just simple because it does not use time value of money, so no need to discount the cash flows. We are told that the quick cash flow returns on initial investment help in maximizing liquidity because payback period emphasizing quick recovery of the initial investment cost. So the company becomes liquid because it doesn't stay long without having its money back. And then you're told the quick cash flow returns on investment help in minimizing risk. This is the point here, minimizing risk. We minimize risk because further into the future, the further into the future, the further the uncertainty, the more the uncertainty. So as we just bring the future, we just try to recover money earlier. That means we reduce the risk. But also here we're told it is widely used as in practice as a first screening method. The point here, it is used as a screening method. You just take the investment, you just try it as fast as possible the first time to get a picture of whether you should proceed further on performing other investment appraisal methods or not. But also at all, it identifies quick cash generator. That's easy. You can just have quick cash generator. You have to know which investment will generate money earlier, so that I'll just be basing on such investments. So it's just like that. Then we have disadvantages of payback period. What would be the disadvantages here? First of all, we say total profitability is ignored. Of course, we do not use profit here, we just use cash flows. So that's obvious. Then we are told time value of money is ignored. This is a non-discounted cash flow method. All non-discounted cash flow methods have got this disadvantage. Also, we are told that it ignores cash flows. That this is a very, very nice point. You will see it when solving the question. Actually, this is our last method. After this, we'll have to rest. It ignores cash flow that occur after the project has paid for itself. This is a very, very big disadvantage. Ignoring cash flows after the project has paid for itself. You know, you can find that a project that pays itself in 2 years, and you can just take that and ignore the one paying itself in 4 years. But actually, that paying itself in 4 years, you could find that in the 5th year, it will earn a huge, huge sum of money. But you have discarded it because your main attention, your main concern was on reducing, taking the shortest time possible to recover the initial investment. So it's just like that. That's why we're saying a project that takes time to get off the ground but earns substantial profits once established might be rejected, whereas a smaller project paying back more quickly may be accepted. All explanations complete and clear. And lastly, we're told here that the cutoff period for deciding what is acceptable is arbitrary. You know, actually, how do you obtain the target, let's say target payback period? How do you know this target payback? How do you say that this project should pay itself in 3 years? How do you establish? It means that the establishment of the target payback period is arbitrary. And after here, I will take you directly to an example, and then we will say enough for today. So here, this number 1, number 2, number 3, number 4, these are just questions for accounting rate of return. Now let's do question number 5. And after here, I'll have to say good night. To me, it's night here. You know, to you, I think it's afternoon. So project XY had the following cash flows. Now, and for the time being, we just presume to have the cash flows ready. But in the next, in the future, actually in the next sections, we'll see how to determine these cash flows. So project XY had the following cash flows. Project year 0 to year 4, we have the cash flows 100,000 negative. Most probably the initial investment. It's common for investment appraisals that you have the cash outflows at the start of the period. And then year 1, 25,000, year 2, 35,000, year 3, 30,000, and year 4, 50,000. And we are told further, we are getting further information here that the relevant discount rate is 10%. So in case you need to discount the cash flows, you would use 10%. But for our case here, we're just dealing with payback period. So this would have nothing to do with us. So we're given A, what is project XY's payback period? What is project XY's payback period? And then we're told, should the project be undertaken if the target payback period is 2.5 years? Now let's try and get down to this. Let's take a look and get down to this and see whether there's something we can do. All right. So the following are the steps to do when doing a payback period question. So you just list your cash flows here. Year 0, this figure, year 1, this figure, year 2, year 3, and year 4. You just, this is the table, only table you have to, or this is the only column you have to add here. So you start. Year 0, I had negative 100,000. all you have to do is just accumulating this figure. That's why here we said cumulative cash flows. So you take 100,000 negative plus 25, and you end up with 75,000 negative still. At the end of year 2, you'll have made 35,000, and if you add here, you'll still have a deficit of 40,000. Then at the end of year 3, you'll earn 30,000, and if you add here, you'll have a deficit of only 10,000. In the last year, you'll earn 50, and if you add to negative 10 here, a deficit of 10, you'll have a net value of 40,000. So this is net value. Now, it's not necessary to deal with all years from the start to the end, but what I'm talking about here is payback period is computed at the point of this when the cash flow changes its sign. You know, when the cash flow changes sign. Oh, now see, here it was negative, negative again here, negative again at the end of year 2, negative at the end of year 3, but positive at the end of year 4. So this is the crucial point at which you have to compute the payback period. Now, how do we do that? How do we do that? How do you compute that payback period? It's easy. You just look at it this way. Now, listen. After reaching at this point here, you say payback period equals to, take this number year 3 just before the cash flows went to the positive. This means it is negative 10, and you have your 3 here. Then add, you take this figure in the same line with 3, which is 10,000, and you divide with this figure here, 50. So it's like you take a diagonal and you divide by 50. Ignore all this negative sign and you'll have 3.2 years. But actually, this is very, very logical. Let me show you how we obtain it actually. You know, up to the end of year 3, we had negative 10, right? Negative 10,000. That means 3 years had ended, and 3 years had ended, and we still hadn't recouped your money back. Now ask yourself, at the end of year 4, you know, to recoup the investment, it means we have to move from negative 10 to 40,000. From negative 10,000 to, sorry, to just recoup the investment, we have to move from negative 10,000 to 0. To 0, that means that cash inflows and the cash inflows and the cash outflows will be the same, right? Or simply speaking, initial investment will be equal to other cash flows. So that's why we are saying that you could just say 3 plus the difference from minus 10,000 to 0, which is 10,000 itself, over the difference from negative 10,000 to 40,000. Now 40,000 minus negative 10,000, you have 50,000. Just like this. That's why, to make matters simple, don't waste your time in an exam. You just come to this year just before cash flows change sign to positive, which is year 3. You add this figure here, taking it as a positive, over this figure here. Because 40,000 minus negative 10 equals to 50. That's why no need to hustle. You just take this one and you come this way. And you'll have your 3.2 years, just like this, and you'll have your payback period ready. So you can just proceed. Our question required us to do what? We are told that should the project be undertaken if the target payback period is 2.5 years. Now, we expected our project to pay itself in 2.5 years, but actually it paid itself in more than 2.5, which is 3.2. So we say, since computed payback period is beyond the target payback period, the project should not be undertaken. So the investment is not worthwhile. So thank you very much for being together with me. We are done with this. We'll be using this same example to do discounted payback, net present value, as well as internal rate of return. So I think you can, next time actually we'll proceed with this, let's say, this discounted cash flow methods.